Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Well, hello again, everyone. All of you listening on the radio, all of you listening to this as a podcast, all of you all around the world, from the Seattle area to, I know for a fact, London, England, because I just answered a question for a guy in England yesterday. So thank you all for listening. We're glad you're out there. I'm Don McDonald, down here in Florida. That's Tom Cock out there in Seattle. And somehow, through the miracles of modern science, we're somehow able to get together and do this little get-together show thing. And what do we talk about, Tom? One word.
Let's see.
One
I
word.
think this
One
week,
word.
we'll try money.
Money. There you go.
Money. All right. Yeah.
That's it. And if you want to talk about it with us, the phone number is 855-935-TALK, 855-935-8255, 855-935-TALK. You can also send questions in at talkingrealmoney.com, but they won't get answered right away. It takes a while on those. If you call today, though, it is really fast. Really, really fast. And before we get to our phone calls, we want to talk a little bit about something that comes up. It's a recurring theme here on Talking Real Money. It's two numbers, 60 and 40. 60 and 40, a.k.a. a balanced portfolio.
60% of your money in stocks, 40% of your money in bonds. Which, by the way, year to date, this has been horrendous. You're down 3.8% year to date.
For a balanced fund?
Yeah. Hope you're not sweating too much on that one.
Is that why my portfolio just doesn't look that bad? Is because I actually have a pretty good balance? Yeah.
Quit looking.
I know. I got to quit looking. I don't look very often.
Yeah, I know. But, I mean, the 60-40 has been declared more than Tom Brady's career. I mean, come on. One day it's here. The
Thank
next
goodness.
day
He didn't use Rasputin this time.
I know. You weren't going to let me use the dead Russian guy anymore. I mean, so the thing is.
Is he actually dead? Do you know that for sure? Have you seen the body?
Good point. I'm watching my back right now. I mean, because the 60-40 has been around for a long time. It's, as Don just said, a traditional balanced portfolio. A lot of people use it in retirement so you get some exposure to stocks. And you got the bonds there to sort of, keep things from fluctuating too much until it's this year. But people said it's dead because bonds are paying so little, right? I mean, there's no reason to own 40% of your money in bonds when they're not paying anything. Right?
Right. But the fact of the matter is, we can't judge investments. And this is our biggest mistake as investors. We judge them by what has just occurred, not by the long-term history of the investments, not by the potential in the future, but only based on what has just occurred, which is why we get so many calls from people saying, I'm selling all my bonds, or even worse, I just sold all my bonds. Where should I put my money? Back in bonds. Why did you sell them? Well, because they were doing badly. You're killing yourself. That's what I'm telling you.
And so the reason that, there's a piece from an industry publication that said maybe it's going to work out.
Oh, good. It's back again.
maybe it's going to work out because, what the 10-year now is at 10-year treasuries now right around 2. I looked at the yield on the Vanguard total bond. It's about 2. The Vanguard short-term investment grade, about 1.8. So, yeah, while bond prices have come down this year because rates have gone up, if we get to this place where, again, bonds are returning this 3 to 4%, you get, 7 or 8 a year from stocks. Now, all of a sudden, you're going to be making the 60-40 at around 6 or 7% a year. That's a pretty good return for most people in retirement. Keeps you well ahead of inflation, will allow you to draw out at 4% of your portfolio. So, yeah, this has been counted out many, many times. And I'm glad to see someone saying, well, maybe you shouldn't be counting it out. And this is something we talk about all the time. If you're over the age of 50, you should have a plan that looks at your retirement income that helps you determine how much risk you need to take. And you should stress test that plan to see how it does in very difficult times, in great times. Don pointed out, by the way, if you look at the 60-40 going back to 1970, you've made well over 9% a year. I mean, it's been absolutely awesome. Because, those the interest rates basically had a 30-year period where they came down.
And if you were globally diversified since 1970, your average annual return would have been literally right at 10% per year, despite all the bad things that happened along the way. 855-935-TALK. Call us.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
It's your money and your life, not or your life. Your money and your life here on Talking Real Money, Real Life. I'm Don. That's Tom. And Carl has joined us at 855-935-TALK. Hey, Carl, welcome to the show.
Hey, guys, how are you?
Good, sir. Thanks for the call.
Okay.
What's up?
Okay, Don, a couple of weeks ago, one of your podcasts, the title was Clickbait. Remember that? And it had to do with the Motley Fools. They had these headings on the Market Watch. And
yes, I
when
remember
you click
that.
It's from them, and really it's their way to sell something. And I couldn't agree with you more. That's pretty bad. But I really take issue with Tom's follow-up comment.
Uh-oh, Tom, you're in trouble now, dude.
Yeah, go.
Tom,
You talk to Tom. He's right here. Take him down a notch.
Okay. You kind of surprised me. Your immediate follow-up comment to what Don had said was, well, yeah, just like, in Chuck Jaffe's column, he said how he was talking about the Bloomberg 60-40 portfolio that it got hammered this year. So, okay, I'm not arguing about that, your interpretation of that, but what really surprised me, Tom, was how you're putting columnist Chuck Jaffe in the same paragraph as the Motley Fools. Remember, Chuck, has a podcast. He's a financial journalist. He doesn't sell anything. He has a podcast where he interviews money managers or fund managers or authors, and he has a weekly column, but he's not selling anything, right? So for you to put him in the same bucket, for you to put Chuck Jaffe in the same bucket as the Motley Fools is me putting you in the same bucket as, say, Stan the Annuity Man or Fisher Investments. You follow me?
You follow?
Yeah, I think let's go back to that. I think those are fair comments. By the way, I wouldn't be upset in being putting the same company with Ken Fisher because he's been very successful RIA. I don't like the way he manages money, but he's been incredibly
And by the way,
successful.
let me just throw in an aside before you talk about your comments. Yeah. I know Chuck really well. Chuck and I have been talking together for many years. And there was a time when Chuck slammed my advice from my radio show in his column, and I've taken him to task. We take each other to task when we disagree, but I got to tell you, I know Chuck has a good heart about it and takes it for what it is, a criticism of his beliefs. So I just want to throw that in.
Yeah, and by the way, back to your kind of point, Carl, which I think is fair. I would not put the Motley Fool, which, as you correctly point out, is in the business of selling their newsletters, selling their trading service, selling their stock picking service, in the same company as Chuck Jaffe, who really has dedicated his career, I think, to helping people. We have a few differences with him from time to time about he wants to still put people in actively managed funds, and we believe in indexes, et cetera, et cetera. That said, I will stand by my comment about the use of the word hammered, because when you tell people something got hammered, here's the way I see it. And I know, because I've seen this up close and personal. People get a sense that I got to do something here. If this has gotten hammered, I don't want to be a part of it anymore. And so my take to Chuck was, well, hammered a loss of 4% is not a hammering. I've been hammered in several things, so I don't think that's a fair comparison.
You took him to task not on the content, but on the emotional component of the comment. You didn't disagree with the comment. It was a bit sensational. He's in the media. Guess what we tend to do? We do it too. We get a little sensational in our hyperbole.
So I think what you're saying is fair, Carl. I would not put them.
No, they're not.
On the same page in any way. I think the Motley Fool really. I mean, these are guys that used to say never own mutual funds. Now they're in the mutual fund. I mean, they've gone all over the place, and it kind of aggravates me that their advice is in the Seattle Times every Sunday as well. I don't like that.
And by the way, speaking of the Motley Fool, Tom, do you know what they charge for the Motley Fool One service? Motley Fool One. It's called.
Does means you're going to be number one in your neighborhood?
It means you get access to all of their stock services, all their stock picking services.
Yeah.
Every single thing they put out, you get access to every single one of them for a mere
how much?
$14,000 a year.
What?
$14,000 a year.
Yeah, that's crazy.
For a
and Carl,
newsletter.
by the way, yeah, that's crazy. Carl, thank you for calling us, and I'm happy to always discuss and defend or walk back things that I have said in the moment that maybe should be walked back. So that's fair.
Guess
Absolutely.
what? We've been doing this in the public eye for a really long time. We're used to it. Thanks for the call. 855-935-TALK is our phone number. Don, you're next. Welcome to Talking Real Money.
Yeah, hi, guys.
Hey.
My subject that I have to have a question about has to do with annuities. I was
one of our favorites.
I was recently pitched an annuity by a financial advisor, quote unquote fiduciary.
Sorry.
And in lieu of taking my lump sum, or in lieu of taking my pension/annuity at Boeing when I retire, I could take the lump sum and invest in an annuity that this person said that would pay me about $400 more a month than what I would get at Boeing.
So in other words, either take the lump sum from Boeing and handing it to them.
Yeah.
Okay. Or let Boeing
Right.
annuitize the amount and pay you out over time.
So tell us more. Tell us more.
So, on average, what he proposed to me, the annuity would yield for guaranteed for life, what he said, would pay a little over 7% per year. Whereas my Boeing pension annuity would be a little over 5%. So it equates to roughly about $400 more a year. And as you know, the Boeing annuity is not adjusted for inflation, so it's that much over.
Nor would his be, I would guess.
No. So I thought 7% just sounded a little too good to be true for the rest of my life, guaranteed.
But you have to. But Don, you have to remember something really important about that number, 7%. That is not the return on your investment. That is the income stream from your investment. And I'd have to read the fine print, but I'm going to ask you to hang on for just a minute. It also includes a return of some of your money to you, too. And this is the little gimmick that goes on with all annuities that doesn't make me happy because they should never quote that without saying, this is also your money coming back. We'll be right back.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And once again, your questions needs really drive what we do because we like to help you at 855-935-TALK, 855-935-8255. I'm Don. That's Tom. We're talking to Don on the phone, has a 401k at Boeing, got pitched by a fiduciary. We'll see. Probably not, because a 7%, somebody pitching even a 7% income immediate annuity, that's on the very high side of the industry right now. I have looked at some immediate annuities that were more in the 5, like Boeing.
And remember, what you just pointed out is correct. This is not return on the investments. This is what you're getting out of it. I mean, and so to go back, Don, I mean, number one, I would say first thing you have to look at is, do you need or do you want a regular payout from your work years, or would you rather have the lump sum? That's one, because there's a big difference there, right? I mean, you're already going to be getting Social Security. And I think Don said this is your 401k. I think this is really your pension payout, not your 401k. So if you have another 401k,
pension,
then
sorry.
maybe you might have, one where you do get the regular payout, and then you still have a 401k that is a lump sum. That's one. So the first part is to have a plan to make that determination. And then the question really is, when you give that money to somebody else and have them pay you back, that's a trade-off, right? You now have a middleman sort of standing between you and your money that's saying, here's how much you get, here's how it works for a long period of time. And that's something to consider as well, I think, around all of this.
Yeah, and the fact of the matter is, Don, that you have to take a lot of things into account. This requires some study to see what it is. What's the quality of the insurance company standing behind this deal? What is the fine print? I guarantee you there's some sort of fine print. And why would theirs be so much better than Boeing's in the same marketplace, basically? They're all dealing with the same kinds of investments. How can one pay so much more? And that's where the rubber really meets the road, proverbially. So I would suggest you look at this really, really, really carefully, because something is amiss, and it's usually in the fine print. There's something buried there that says, oh, by the way, if this happens. And the other thing you need to remember is are you comparing apples to apples? Are they single life, joint life? Because you've got to take if you got a spouse, you got to take them into account. There's a lot of things you need to think about. Is there a term certain on one and not on the other? But good luck, Don. Please have somebody else check these things out, though. It bears repeating.
That's a good point, Don. I think that's fair. Take it to somebody else who is a fee-only 100% fiduciary advisor and say, if I do this, is this really legit, or should I just take the lump sum myself, invest it, and take the money? I think that's a legitimate way to look at this.
You should always, 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 when you're shopping for these things, before you do anything, they'll usually send you a copy of the policy after you buy the policy, saying, oh, you can cancel it within. No. Get a copy of the policy before you sign anything. Always. And then, here, I'll put it this way. Let's say I gave you the most boring textbook in the world. This is a incredibly boring philosophy textbook. It's about 1,200 pages long. You don't want to read that, just like people don't want to read policies and prospectuses. But let's say I was to give you $20,000 to read that philosophy textbook. Would you, for $20,000, read that book? That's what we're talking about with prospectuses and policies. Yeah, it can be 10, 20, 30, 100, 500, $1 million at stake. And we don't take the time to read them?
Well, we know, because there was a study done a few years ago that found many people in the insurance industry don't read them nor understand them themselves. This is a product that they sell.
That's one of the most wonderful things. You can even skim it and then go back to your agent with questions on the policy and watch their face when you give them those questions, when you put those to them. They will do things like, I'm going to need to get back to you on. I'm not, mate, not exactly sure how that works.
Or here's another idea. You'll be in town for retirement. Take Don with you when Don's here for retirement into the meeting.
Oh, I'd love to go.
I brought my financial guy, Don McDonald. He's going to sit in the meeting here with us.
Don McDonald from Northwest News Radio. Him.
You heard of him.
Yeah.
That'd be kind of fun to watch.
Yeah. Oh, I'd bring a crew with me for that one. A whole camera crew. That's like the podcast of the century. We should do that. We'll be back.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Reality radio for a really great future. We're talking real money.
Asking your questions is incredibly easy. You can call us at 855-935-TALK, 855-935-8255 here on Talking Real Money. And we'll take those calls live during our show on Saturdays, which is noon to 2 Pacific, 3 to 5 Eastern, or you can call 24 hours a day, 7 days a week, and leave your question, and we'll answer that on a future podcast. But right now, we'll talk with someone live, which is a lot more fun. Like Gabriel. I think we should talk with Gabriel. What do you think? Hi, Gabriel.
Absolutely.
Welcome to the show.
Hey, enjoy the show and the podcast especially. Kind of a two-part question. I opened up a Roth IRA back in July before I retired. So can I continue to, now that I'm not working, can I continue to put money in there?
You have to have earned income to put money into a Roth IRA.
Okay, with annuities, I know you guys hate them, but I got
No.
a couple annuities and I got some dividends.
No, that's not
stocks.
earned
Is that
income.
considered?
That's unearned income.
That's not-
Stock
Talking
income
about,
is unearned. What you could do,
W-2 or 1099.
what a lot of people do so that they can continue to fund their Roth if they get a part-time job. They just work a little and they throw that money straight into the Roth, 100% of it.
Okay, so...
But otherwise, you can invest. But now bear in mind, this is something that we get so caught up in the tax ramifications of transactions, we forget about the bigger picture. If you are investing in your Roth in something that grows in value, like a high-quality balanced fund or an index fund, a portion of the return from equities is non-realized capital gains, which are tax-deferred. So you get some deferral, even just investing.
Okay, so just a regular IRA then?
No, you can't do a regular IRA or a Roth IRA without earned income. Just a regular investment account.
Actually, I misspoke. He could do either one if he's married and his partner has
Right. If somebody in the
income.
house has to have income.
Correct.
Earned
Yeah.
income. Let's not just say
Yes, earned
income.
income.
Because it does get confusing. We think, I've got income coming in from Social Security, from a pension, from an annuity, from my portfolio. Isn't that income? I'm paying taxes on it. But not when it comes to funding any kind of a qualified retirement plan. Those require earned income.
That's correct. Did you have another question,
Wow,
Gabriel?
That blows me away.
Sorry, sir.
Sorry.
Yeah, I might be... you still there?
Yeah, we're here.
Yes.
Okay, yeah. So I might be getting a small inheritance, and I'd have like $100,000 to invest in something. What would be my best tax thing to invest in so that I don't have to pay all the taxes on it? Is there anything that you guys...
Wait. Why? Where's the 100,000 coming from?
Oh, a dead brother died, and we're finally selling the house. It's about $250,000.
There's no.
I'm going to spend most of that.
Okay, there's no tax on the inheritance.
Okay,
But I think Gabriel was saying how to invest it and, not put taxes. I mean, here's an idea.
Exactly.
The most tax efficient. Well, yeah, okay. We could get into the whole argument about whether or not it's really important to pay that close attention to taxes on $100,000 of an investment. But if we all agree that it is, then the best vehicle would be exchange traded funds, which by their operation, due to the fact that they hand stocks from one hand to the other rather than selling them and creating a tax hit, using exchange traded funds are very efficient And you can get them extremely low cost. Don mentioned, like a balanced fund or something, which would be a good place.
Well, but you got to know more than just, I have $100,000 and I don't want to pay taxes. You got to know, what is this $100,000 going to do, Gabriel? What's it for?
Money. I'm going to need money. I'm retired. I'd like to travel.
No. I get that. But what are you going to do? When are you going to need the $100,000?
Oh, I hope.
Do you need income from it now?
I'd like to.
Yeah, see? Okay. Then
like
Tom's idea of the balance
yeah.
fund may go right out the window. This is why it's so important that you know things like, what am I going to need this money to do for me? When am I going to need to do it? And how much risk can I take?
Talking real money.
At some point, most investors need professional financial guidance. So get a little bit of free help or a lifetime of affordable 100% fiduciary guidance at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
All right, let me give you our phone number again so that you may call us if you have a question for us. That's 855-935-8255 or 855-935-TALK.
I know you were very frustrated with Gabriel.
Well, I wasn't frustrated with Gabriel. I'm frustrated with the question. I mean, literally, this is becoming known as in our between the two of us as the question.
And what Don is referring to is that the number one question we get is, I came into this, I'm in this situation. All of a sudden, you have this money. What do I do with it?
Right.
That's always the number one reason people call.
It's the number
which
one
is
reason.
fine.
No, it's fine,
what
we have to do is do something that is counter to what you're asking us to do. It is totally contrary. You're saying, please, Don, please, Tom, tell me which fund. We can't. It's literally impossible. When we do that, we do you a horrible disservice, in my opinion. I think we do.
I think that's fair, because if you need the money, as you point out, in the next short time, you really shouldn't have a bunch in stocks.
That's why there's so much more to that question. And I think it behooves us, as boring as it may get, to ask those questions. It's like when I ask Gabriel, what do you need this money for? Well, it's money. I need it. Right. That's the point. But what? There has to be a what. You have to think about this. You have, as an investor, you have a job to do, unless you want to go hire somebody to do it for you or to help you do it. Even a good advisor can't do it for you. They have to help you do it.
Well, it's the less interesting part of the business. What you want from us is, what does the future look like, and how should I invest based on that knowledge?
Yeah, but what you're asking of us is, tell me what to do right now.
Yeah.
After one sentence, and that's just not possible. Here are the things you need to know. You need to know these things before you call. I know you won't, but listen anyway. Humor me. Okay. 1, you got this money coming in. When do you need to use this money, either in its lump sum or lump sum components, or as a stream of income? And which of those do you need? Do you just need a stream of income? When do you need that stream of income? 2, is it essential? Is it absolutely, I must have X amount of money, whether it's the lump sums or the income? 3, how comfortable am I? Now, this is the hardest part of all, because we all say we're not comfortable with any risk, or when things are going really well, like the stock market was doing in the past, we go, oh, I don't care. Just get me into that stock market thing. That's doing great. No. How much, literally, how much are you comfortable losing in reality before you panic out?
And how much volatility? I'd say
that's the volatility.
Losing, how much volatility?
Yeah, but I don't think people understand volatility. Really, it comes down to, I got $1 million or I got $100,000. If it goes down to $50,000 in 6 weeks, what am I going to do?
I'm going to pull my money out and move it over to high yield savings account.
Then you shouldn't be in stocks.
Yeah. No, I think that's very fair. And by the way, and we offer, by the way, around the volatility, a free risk quiz. that
Yeah,
many
that's why we
thousands of
did
people
that.
have taken. Yeah, you simply go to it's at Talking Real Money too, right?
Yes, it is at talkingrealmoney.com. Just
You
look
take
for the
the quiz.
risk quiz. Take that. That is going to teach you. I don't know why every single person who listens to this show doesn't go take the risk quiz. I know why some don't. They think they're going to get a sales pitch. Are they?
Well, they're scared of the electrodes too. Those, with the shock, it can be a bit of much of a test.
I'm
So I
telling you,
understand
no.
that.
The Consumer Product Safety Commission made us pull the electrodes. So
What?
now it's an implied thing. It buzzes at them.
I was really loving watching those on YouTube. That was really fun. Okay, but back to what you're really saying is here's the reality. You got to have a plan, because if you have no plan, and if I had no plan and I came into $10 million tomorrow, I wouldn't know what to do with that 10. I don't have a place to put it.
And before you
I'd have to see how plugged in.
Well, okay, but let's say suddenly somebody died that you inherited $10 million. You got the money. Don't do anything with it yet. Okay? All right. 855-935-TALK is our phone number. I'm going to stop. I'm going to get off my soapbox now. Frank, welcome to Talking Real Money. Hello, Frank.
Hello?
Hello, Frank. What's up?
Oh, I got a question. You pay taxes on a rollover annuity.
Oh, turn your radio down first. On a rollover annuity. No, if it goes into another annuity, that's an exchange that is a tax-free event. If you take the money out, yes, it's immediate. It's not like a rollover IRA. You can't take the money and then put it back in. You've got to do a transfer from one annuity to another to avoid the taxes.
Next question. What's the difference between an index annuity and a variable annuity? Is there any difference?
Huge difference.
Yes, sure. A variable annuity is an annuity product that has investments in it.
Mm-hmm.
An equity index annuity really truly is the investment. And Don can explain how they operate. Well, the variable annuity is there's an aspect of you make what the market provides depending on how it's invested.
You make what the investments in that
Correct.
portfolio make. So you could have a stock fund, a stock and bond fund, a balanced fund, any kind of fund in that variable annuity. So you pay for the mutual funds and then you pay for the insurance component that makes them tax deferred only, and it's hardly worth it. An indexed annuity gives you a portion of the return of a particular market, not including dividends, up to a cap, and a guarantee from the insurance company that your return in a year will never go below zero. So with indexed annuities, it's closer actually to a fixed annuity with a little volatility than a variable annuity, which is actually an investment. An indexed annuity, generally those have been paying in the 3 to 4% range when you shake everything out.
No.
It's just it's a complex gimmick created by the insurance company to make it appear you have the potential to make more money, but you really won't.
Okay, index annuity guaranteed 7%. This is also basically almost impossible, right?
That's not. Basically,
that's an
that
immediate
is
annuity.
impossible. What they're saying is we have an indexed annuity that you can convert, and if you convert it in the future to an immediate annuity, we'll give you a 7% paycheck. It is not a 7% return because part of the money is your own money coming back. This is the problem with the insurance industry and their investment-like products, is that almost to a human being in the insurance industry, they don't tell the truth. I almost said the bad word I couldn't say. They don't always tell the truth. They obfuscate.
Can we squeeze Paul in here?
Not a chance.
Okay.
No. Sorry, I truly wish we could, but unless you can do a 15-second answer to a 15-second
No,
question.
and I do want to mention program note. The other Paul Merriman, will be here next Saturday. Don will finally get a day off for the first time in like 25 years.
It's my wife's birthday. I told her I'd take her out for her birthday, and I'm taking the day
So Paul
off.
Merriman will join me, and we will do it live together. So there's something to look forward to. Not that I don't enjoy doing it with Don, too. So next Saturday.
We'll be back.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And now, ladies and gentlemen, here's Tom.
And you want to see Don, myself, Paul Merriman, Paul Lupescu, Herb Weisbaum et al. In person? That's right. We're doing it. May 14th, Retire Meet in Bellevue at the Maidenbauer Center. Includes a great lunch. Join us. This is a great event to learn about everything related to retirement at Retire Meet. Saturday, May 14th. Sounds like a pitch. Saturday, May 14th. It does.
And you sound like a salesman right now.
I sound like
you really do.
I'm selling it.
And
you got to come.
Is free.
It's a great event. Parking is free. RetireMeet.com.
Retire, M-E-E-T or M-E-A-T.com.
Join us.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. To keep the lawyers happy.